markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ do remain lower. Stocks have paired losses as traders assess the minutes of the latest Federal Reserve policy meeting, with geopolitical tensions still weighing on markets. S&P cut its decline by about half, while the dollar fell. Treasury yields fluctuated. 10-year yield right now 2.03%. We've got gold up 9 tenths, $18.70 the ounce. West Texas Intermediate crude up 1.6%, $93.51 a barrel. Equity markets lower. The Dow, the S&P, NASDAQ all declining right now, with the S&P down 16, down by 0.4%. The Dow's down 160, down 5 tenths. NASDAQ down 112, a drop of 0.8%. Fed officials did conclude at their January meeting that inflation was running too high as the economy closed in on full employment, warranting a hike in the benchmark interest rate soon. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it, Charlie. Thank you so much. Just want to bring you one COVID headline. White House Chief Medical Advisor Anthony Fauci saying at a briefing earlier that the dynamics of the COVID-19 outbreak in the U.S. are pointing sharply downward. That's a trend line we'd like to see.
Yeah, we're not seeing it just out here in New York City, but throughout the United States as well. Let's get into it with Michael Dowling, President and CEO at Northwell Health. He joins us on the phone from Long Island. Michael, it's great to have you back with us. You run New York's largest health system. Give us an idea of how things are looking inside Northwell Health right now.
Oh, things are looking very, very well indeed. We are definitely on the exit ramp of COVID, and consistent with what Dr. Fauci indicated. We only have about 500 COVID patients in our facilities today, and it is dropping each day. So we're in a good place. We're moving back to normality, and which is, I think, what we've all got to start beginning to do now, even though COVID will always be hanging around for quite a while. But the degree of severity is much, much less, and things are looking very, very positive indeed.
You know, Michael, we know it wasn't easy, and I'm sure I can't even imagine the stresses as you guys went through it. And we just kind of looking in and hearing what was going on in healthcare systems like your own. My understanding is you kind of threw the budget out the window. How do you do that? Because you do have to ultimately think about the top and bottom line. I know there was government assistance in some cases, but how do you do that? Or do you have no choice?
Well, I mean, it's a standard thing with us because we've had this situation with Hurricane Sandy, Hurricane Irene, and ever so often bad things happen to you, and you've got to be able to react, and especially when the community is in danger, either from a hurricane or a thing like COVID. You can't be going around each and every day worrying about the budget, because you will not be innovative, you will not be creative, and you will not respond to what is needed to be responded to. So my message was, do what is right. Do everything we possibly can to help people, save people, protect people's lives, and we'll figure out the budget and the mechanics of it later. Because otherwise, you're going to be constraining your activities. So during the height of COVID at the beginning in 2020, our revenue dropped well over $1.5 billion.
Wow.
And there were scary moments, but we know that we knew that we had the attitude, we're going to win against this virus. The virus is not going to beat us. We're going to win, and then we had to come back and rebuild. And this is what you do in a crisis.
Where are you, Michael, in terms of rebuilding now? How do you get back that lost revenue?
And I believe we will come out this year. We will come out positive from a financial point of view at the end of this year.
So fully recovered financially?
The federal help, I was just mentioned, the federal assistance helped, but we started to kind of pivot to bringing back regular business, a couple of months after the height of the COVID crisis in the spring of 20.
One thing I'm curious, and we were all talking on our planning call this morning about the business of running a healthcare system. And I was having a conversation with a doctor earlier in the week about just how slim the margins can be in terms of a hospital running efficiently and as it's supposed to all of a sudden the system being maxed and strained. How tight is it?
It's very, very tight. Remember, we are a $15.3 billion entity. And we're not just hospitals, as you know very well. We have huge ambulatory, outpatient, and home care, and all of that, plus academics and research. But we run at about a 1 to 1.5% margin. It's tight. So you've got to be very efficient. You've got to be quite productive. You've got to be very, very careful of how you operate it. But you've got to move forward each and every day with a great sense of optimism. And still do everything you possibly can to make sure we serve the community to the best of our ability. It's not hard to make a margin. If you decide, for example, to sit back and eliminate those services that you lose money on, or those things that you do that you get no money at all for, then you can come back and say, oh, we're doing great, we have a huge margin. But that's not, in my view, that's not why we're here. We're here to do well, and we're here to do good. And if we have a margin strong enough to be able to, feed our balance sheet, commit to the investments we need to make in technology, in people, and in infrastructure, and then show a 1 to 1.5, maybe up to 2% at the end, we're doing well. Now, not as well. We're in New York. It's a much more expensive place to be. We have unionized staff, which is more expensive. So you will see places around the country that have much higher margins. I'm not worried about them. I worry about what we do. And I think we focused on mission, and as well as making sure we make a margin to sustain our ongoing business.
Well, Michael,
that's why we're here.
What are the permanent shifts that you see in your business on the other side of COVID? What are the permanent changes you have made at Northwell Health?
Well, it accelerates a lot of what we were doing. Okay, not a complete shift, but an acceleration. So, for example, COVID demonstrated the unbelievable benefit of having large ambulatory outpatient entities, because they actually treated an awful lot of COVID. If you didn't have those, you'd be in trouble. It accelerated the use of home care. It dramatically accelerated the use of technology. So we will never again be exactly the same. And COVID to me was a phenomenal learning experience,
right?
And a catalyst for change. Well, it's in many ways, I would say, it's one of the best things that has ever happened. Now, that's difficult to say because of all of the,
But we learned a lot. We learned a lot. Well, Michael, just got about 20 seconds. If there's one thing that has changed dramatically and for the better, what is it? Because of what we learned during the pandemic, and just quickly, if you could.
It proved to us that we can be remarkably agile and flexible. And if we can continue to maintain that culture of innovation, creativity, and be able to change quickly and build it into our culture, then there is nothing that we can win in the future.
Well, good luck in the future, and thanks for finding time once again. Michael Dowley, President and CEO at Northwell Health, author of the book Leading Through a Pandemic. He was named to Modern Healthcare's magazine's 100 Most Influential People in Healthcare, ranked number 3 overall. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Block trades, you into it?
Are regulators into it? I think that's the bigger question.
Well, they've been into it for a few years,
Yeah,
and they
they
got
have.
a little assist from Morgan Stanley, kind of-ish, right?
Yeah, and we are approaching a year from when the Archegos blow-up happened. I was looking back at Viacom CBS stock yesterday.
Yeah.
You can see that reflected in the year chart.
It's amazing, right?
Yeah.
All right, folks, we're going to talk about this. It's among the most read, and it's a Bloomberg exclusive. In the meantime, we're going to talk about the equity turnaround, Charlie Pellet.
Indeed. Let's begin right there. S&P up by 9 right now, reversing earlier losses. Have been down 41, down 0.9%. But right now, green on the screen. We've got the Dow little change. NASDAQ down 10, drop there of less than 0.1%. But as Carol said, turnaround. That is the key takeaway here. Up by 9 points right now, up by 0.2%. So the S&P 500 index erasing losses following the release of those Fed minutes. And with the story, here's Bloomberg's Vinny Del Giudice.
The minutes reinforce signals that higher interest rates are in the bag and the Fed could start tightening soon, perhaps at a faster pace than the last tightening cycle in 2015, perhaps the next meeting in mid-March, with inflation running at the fastest pace in 4 decades. The Fed cut its benchmark interest rate to near zero to avert a financial crisis when COVID-19 struck 2 years ago. Vinny Del Giudice, Bloomberg Radio.
And right now we do have the 10-year yield, 2.04%. Moments ago, the Dow turned positive, swinging between gains and losses. Right now, looking at a 3-point gain in the Dow Jones Industrial Average. NASDAQ, as I mentioned, lower by 6, down now by less than 0.1%. S&P, best level of the day now, up by just about 10 points, up 0.2. 10-year yield, worth repeating, 2.04%. Spot gold up 0.9%. 18.69 the ounce. West Texas Intermediate crude up 1.7%. 93.68 a barrel. Workers at an Amazon.com facility on Staten Island will be voting on whether to unionize, this according to labor organizers. They say the election will be held in person from March 25th to March 30th. Amazon shares right now up by 1%. Among the names reporting after the bell today, Cisco Systems and NVIDIA. I'm Charlie Pellet. Fed Wednesday. That's a Bloomberg Business Flash.
Woohoo, did you get the hat?
I wish I had. You know, we ought to do that. Bloomberg Radio hats. Give them out to our listeners.
Branded
Wonderful idea.
merchandise.
Exactly.
Come on, everybody.
Love the idea.
All right, Charlie, thanks so much. Well, among our most read on the Bloomberg today, it's a Bloomberg exclusive, and it's about Morgan Stanley's role in reinvigorating a federal probe examining irregularities in a very lucrative market for Wall Street. We're talking about block trades.
Yeah, Srinath Rajan is finance reporter for Bloomberg News. He's with us in the Bloomberg Interactive Broker Studio. Let's get some definitions, Sri, just out of the way here first. What is a block trade?
Large chunks of stock that you need to sell, and it has to be privately negotiated. You can't just dribble them out, because if you do that over a long time, it'll take a while. You'll have adverse price action. You might as well figure out a right price at which you can sell off, usually at a discount to where the stock is trading. Say you own a big chunk of Apple and it's trading at 100. You negotiate a deal and it's usually at a discount, so you probably sell it to the best bidder at 95 or 98, and then they hope to parcel it off to other people.
So I remember years ago where we would, Laszlo Barini was really into block trades and money flow, and we would track the big moves by institutional investors when they sold a block and watch the money flows, because it was usually an indication of where a stock was going. We've gotten away from that big time, like through the tech crisis and run-up, if you will. What is it that's at stake, or what is it that investigators have been looking at when it comes to block trades?
Effectively, if some people have been blurring the lines and going from the gray to the black, what they're really trying to figure out is when banks get mandates for some of these block trades, are they tipping their friends in the hedge fund world? Are they front-running some of that information so that they can pre-position themselves, possibly by shorting the stock? Because you know when a block trade hits the tape, the stock is going to trade down because a large amount of the stock is coming down the pike, and that will drive the price down. So if you're short the stock, you're bound to make money. So is there some wheeling and dealing going on where some of their clients are shorting the stock so that when the block actually comes through, the bank can tap on their shoulders and get them to buy that? So both sides are happy. Clients are in a way beholden to the bank, and the clients are making some money. That is obviously not good. Remember that a lot of this operates in the gray area. It is murky. When you're bringing a block trade, what is the hypothetical conversation you're having? Is it really a legal conversation or even a confidential conversation if you don't have the mandate yet? These are some of the things we imagine that regulators, prosecutors will have to wrestle with, and it won't be easy to solve. And that might be one reason that might be giving faith and belief to a lot of the defendants that, and when I say defendants, I'm just talking about the people who they've sought information from right now because they haven't even charged anyone. But that's the kind of thing that they would have to solve for and figure out if they have a real case here.
Well, take us back about a year ago to Archegos and the blow up there and how this current version of an inquiry into block trades was really set off by that.
I'll take you further back, Tim, because this investigation into block trades really started off around 2018. As early as 2018 is our understanding. But since then, it waxed and waned a little bit and never really seemed to gather steam. Then what happened? Last year, Archegos, Bill Huang's famed family office, that had this surprise, spectacular run-up and even more shocking collapse. The unwind happened because a lot of the banks, worried about the positions that Archegos held, moved quickly to dump their holdings. And that meant large blocks across a variety of names hit the market. So when investigators a few months down the line started investigating what happened with Archegos, we know that there are inquiries looking into whether there was market manipulation, whether banks are colluding in the sale process. Along the way, they also started looking at some of these block trades, and that seems to have breathed new life into this probe that has looked at this lucrative block trade activity. And from there, it seems to have expanded to other trades that Morgan Stanley, the bank we're looking at, that seems to be at the center of all this, is they're looking at the trades that they brought to market and whether there is more wrongdoing, and some executives at the firm are under the gun right now.
And I think that's what caught our attention. It's like, okay, so where's Morgan Stanley in all of this? So they're being investigated too, or there's no charge? Like, what is it? How do we need to look at this firm?
They certainly seem central to whatever process is going on right now. There seems to be a lot of information gathering from the SDNY, the SEC, and other people. A lot of the threads, based on our reporting so far, tie back to Morgan Stanley. Back in November, we had reported that their head of equity syndicate desk, Pawan Passi, was put on leave. It wasn't quite clear why, but now it's become much more apparent that it was tied to this entire block trading probe. And now they're looking at some of his clients, some of the conversations he's had, some of his colleagues. So it's going to be an interesting few weeks and months ahead as they try and figure out whether they can build a real case.
I mean, ultimately, we could get regulators to rule, right, on this? But you said it's murky.
Regulators, prosecutors, if they have what we think they have in terms of evidence, in terms of being tracking them for a while, it's really hard for anyone on the outside to be able to definitively tell you which way this goes, because I can guarantee you there's someone at the SDNY sitting in an evidence room looking at a pile of stuff who very well could know all the answers.
Well, and just got about 20 seconds or 15 seconds. I mean, block trades, it's a part of how Wall Street works, right?
It's a part of how Wall Street works. It was made famous by the legendary Gus Levy 50 years ago and still a very lucrative part of the market.
Well, incredible reporting, and we said a Bloomberg exclusive and a most read. Sri Natarajan, thank you so much, finance reporter at Bloomberg News.
Well, let's get to Washington, D.C. for an update on world and national news. For that, we turn to Nancy Lyons. Hey, Nance.
Thanks, Tim. NATO defense ministers are meeting in Brussels as Russia continues its buildup of troops along Ukraine's borders. NATO Secretary General Jens Stoltenberg calls it the biggest security crisis in Europe in decades.
Russia maintains a massive invasion force ready to attack, with high-end capabilities from Crimea to Belarus.
Stoltenberg says the situation in Ukraine shows the security risk that Europe now faces. The FAA has reportedly referred dozens of new cases of bad behavior in the air to the Justice Department.
43 new cases of violent, unruly behavior in the air are being sent over to the Justice Department for potential criminal prosecution. That's according to CNN. This week, Bloomberg News reported the nation's largest airlines have been in talks for months with the Biden administration on a national no-fly list of problem passengers. The FAA has opened investigations on more than 1,000 reports of airline violence in the past year, most of them related to mask mandates. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Omicron variant of the coronavirus seems to be waning, and that has the CDC Director Rochelle Walensky saying things are moving in the right direction, but she says it is still too soon to relax mask guidance. Government investigators say former U.S. Interior Secretary Ryan Zinke, who served in the Trump administration, misused his position to advance a Montana development project and say he lied to an agency ethics official about his involvement. He's now running for Congress in Montana. His campaign calls the report a political hit job. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Oh, we are living in interesting times.
We certainly are. Remember a few weeks ago, the Melania Trump NFT?
Yeah.
Okay, we talked a little bit about it.
Right.
Well, Mr. Leni Gafapoulou has a story out that's getting a lot of traction online right now and on the Bloomberg terminal. The money that won this NFT, so the winning bid for it, it actually came from a wallet associated with Melania Trump.
Dun, dun, dun. So basically, the people who created it, bid on it, got it.
That's what I'm seeing.
It's really interesting. So a series of blockchain transactions. Remember, we know it's supposed to be a secretive world, but remember that you could really track this stuff.
Yeah, I think that's a big misconception that a lot of people have
Right?
when it comes to crypto. If you're not like in the crypto world, and that's why a lot of people argue, okay, wait a second, this type of currency is not actually that good for criminals to use because it can be tracked. Look what happened last week with the Crocodile of Wall Street, as they're calling her.
Exactly. They figured it out. Okay, so here's what happened. A series of blockchain transactions show that the cryptocurrency used to purchase Melania Trump's non-fungible token came from a wallet, as Tim mentioned, that belongs to the entity that originally listed the project for sale. The former First Lady began that auction, in January for a collection of NFTs on the Solana blockchain with art from her first official state visit back in 2018. What did it go for?
1,800 Sol, so Solana, worth now about $185,000. Trump listed the winner of the auction on her website along with the bid history that shows that the NFT sold for about $185,000. The collection is titled Head of State. It was one of many planned auctions Trump said she would release at, quote, regular intervals when she announced the launch of her NFT venture back in December.
Now, to be fair, in a statement, the office of Melania Trump said, quote, the nature of blockchain protocol is entirely transparent. Accordingly, the public can view each transaction on the blockchain. The transaction was facilitated on behalf of a third-party buyer.
So,
Don't you ever think about your grandparents, like, what are they talking about?
yeah, I mean, sometimes I feel like that,
It's like,
right?
What?
So what does that mean?
I don't know.
Potentially that
Is
somebody
it-
came in and said, okay, we want to buy this, but we don't have
Is
the
it-
crypto to do it, so can you do it and we'll pay you cash?
Is it like if you're auctioning off something, you want to make sure it sells, you've got like a plant in the audience, and you just say, please make sure you buy it?
I don't know.
Okay.
I think the plot thickens.
Dun, dun, dun. NFTs, a mystery, right here on Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ, all trading lower right now. S&P little changed on the minus side, down 2 points, has been fluctuating, down less than 0.1%. We've got the Dow down 95, down 0.3%. NASDAQ down 48, a drop there of 0.3%. Stocks fluctuating as the latest Fed policy meeting minutes were seen as slightly more dovish than what traders were expecting. Again, the S&P right now, little change. 10-year yield, 2.05%. Spot gold up 0.7%, 18.67 the ounce. And West Texas Intermediate crude now down, now up 1.5%, up $1.41 a barrel, 93.48 on WTI. After the bell, we will be hearing from Cisco, down now by 0.3%. Also reporting today, NVIDIA down by 1%. We heard from Viacom CBS last night, shares plunging 19.2%. Also reporting last night, Airbnb up now by 4.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Oh, we're talking the dynamics of a household. All right, after surging more than 50% in 2020, sales of plant-based meats in the meat departments of grocery stores increased only just a smidgen, 1% last year, Tim.
Yeah, it's remarkable to read that in Dina Shanker's latest article in the upcoming double issue of Bloomberg Business Week magazine. She's consumer reporter for Bloomberg News. She joins us now on the phone from New York City. Also with us is Joel Weber, editor at Bloomberg Business Week. He's with us in the Bloomberg Interactive Broker studio. Joel, I think back to where we were about 2 years ago. I was going to the grocery store every 2 or 3 weeks, okay? Because that's where I was in pandemic mode, using 2 shopping carts, okay? And I was at the grocery store, I think it was a Wegmans, and there was like this whole section of Beyond Meat that was on sale there. And Beyond Meat stock, actually at the time, was doing pretty well.
Yeah, and I think you haven't gone to the grocery store since, I'm guessing?
No, I have gone to the grocery store. You know what?
Taking one for the team during the pandemic.
We do a lot of delivery these days.
Yeah, right. Well,
grocery delivery.
So the enthusiasm among investors and certain consumers was incredibly high for the faux meat, fake meat stuff when it came to market. And we've seen it reflected in, I'm looking at Beyond's share price, which has come down pretty substantially since that moment that you were at Wegmans all those months ago in the before times. But as Dina writes in this latest issue, which I found this to be really interesting, the companies are starting to tack and think of themselves maybe not as always being the main event, into something more like an ingredient. So Dina, walk us through the strategy and how it's playing out.
Hi, thanks. So basically what you have is these companies are no longer getting all the attention from consumers, from people like me in the media, although I do give them a lot of attention. People are getting a little bored with the novelty of a burger made from something other than meat or a sausage made from something other than pork. They're also getting, maybe you guys can relate, getting a little tired of cooking all the time. So the sales have dropped precipitously. And then there's also the fact that they can get meat a lot more easily than they did during that time when you were taking those 2 supermarket carts through the aisles. So all of these things are making it so that people just aren't feeling as compelled to try these anymore. So what are these companies doing? They're saying, but wait, there's more, okay? We can put our fake beef into ravioli. We can put sausage on a pizza. We can put it in a dumpling. So many ways to eat this stuff, and a lot of it doesn't even involve cooking, or at least, real cooking. You can throw this into a microwave. You can just put it in the oven for 10 minutes, and it'll be ready before your next Zoom meeting. So it's really simple, and hopefully, with all of this melted cheese on top or pasta around it or whatever else is dressing it up, you might not even notice that it's not the real thing.
So I have a theory, Dina, and I'm interested if your reporting bear this out, or if it's just an observation from the Weber household, which is when I've cooked with fake meat, it doesn't smell good when it's just by itself. Did that come up?
It did not come up with any of the companies.
Maybe
but
I did something wrong.
Definitely, it is. No. I was going to say it's come up with real human beings that I talk to all the time. I've noticed it in my house. When I say real human beings, I'm using that term really loosely because I'm realizing I'm mostly talking about other reporters. But people have definitely mentioned it to me that there's a funny smell, and I notice it too.
It made me wonder, actually, this is actually maybe a brilliant technique because there's so many things that meat gets added to, and maybe it doesn't need to be meat. It could be fake meat. And, this solves the other problem of maybe not having that. The smell of Joel cooking in your house.
I'm coming over, Joel.
Oh my! I don't know that I am.
Yeah, dinner.
Follow that question up, Carol.
So, Dina, my problem with this plant-based food is that I don't know that it's definitely healthier, and I guess that's what I'm thinking about. That's where food is ultimately moving in terms of direction. Does that hold it back from growth as well?
Definitely. I mean, it is. As a category, there's nothing. Nobody's going to say this category is a health food category. You can go product by product, and some will have a better nutritional value than others. But and that's also becoming a way that the newer companies are trying to differentiate themselves is by saying, look, we're only using a handful of ingredients, or we have fewer calories, or whatever it is. But compared to the real stuff, I mean, it's kind of a wash. You can definitely make arguments that listen, it doesn't have cholesterol, but it has a ton of sodium, and the amount of a beef burger can have literally just a single ingredient in it. So the beef industry will say that's really great. But then, of course, you can make the argument that, hidden in all that beef are a whole lot of, antibiotics that are fed to the animals.
Yeah.
And, synthetic
sorry, I took us to a serious tone there.
On,
I'm so sorry, guys.
Well, Tim will bring it back.
Dina, I'm wondering if. I'm wondering about product pipelines here, because for the last couple of years, the news from these companies has really been, hey, we're working on this chicken version of chicken. What is the product pipeline telling you about their new strategy?
Well, when I spoke to Dennis Woodside, who's the president at Impossible, he said, listen, we're still working on mimicking that whole muscle kind of format, which is like a chicken breast or a steak. And then he didn't put it this way exactly, but essentially what he was saying was, but this is so much easier. Like, I can just take the ground beef we already have and put it in a ravioli. All I have to do is, make that business deal. And that's a lot easier than making a fake chicken breast.
All right. Well, I want real stuff in my ravioli. I'm just going to put it out there. This story in the new issue of Bloomberg Business Week magazine, you can find it everywhere tomorrow. Bloomberg Business Week editor Jill Weber, who's got to take maybe some cooking lessons, and of course, Dina Shanker of Bloomberg News.
February is Black History Month. Every day this month, we are celebrating significant moments in U.S. Black history. Now, with your installment for today is Bloomberg's Renita Young.
On this day in Black history in 1951, the New York City Council passes a bill prohibiting discrimination against African Americans in city-assisted housing. The bill was mainly directed at the Stuyvesant Town Housing Project, at the time a public-private partnership project. Managers of that development prohibited Black tenants who had been active in the campaign to stop racial discrimination. Lawsuits were filed claiming that the project was public or semi-public and thus violated anti-discrimination laws for New York City public housing, which were rarely enforced. 1 month later, the Brown-Isaacs bill became law in New York City. That's Today in Black History. I'm Renita Young, Bloomberg Radio.
A big thank you to Bloomberg's Renita Young for today's installment of Today in Black History.
Coming up, we've got an interview with Carl Icahn right here on Bloomberg. All right, you are listening to Bloomberg Business Week. Carol Master along with Tim Stenovec. We're going to toss over to our TV colleagues. We're getting ready for a sit-down with Carl Icahn.
You're watching Bloomberg. I'm Eric Schatzker, and I want to welcome our viewers and listeners worldwide to this global simulcast on Bloomberg Television, Bloomberg Radio, and YouTube as well. Carl Icahn, the billionaire investor and shareholder activist, has a starring role in a new HBO documentary, Icahn, The Restless Billionaire. It examines his extraordinary career, and it also showcases the campaigns that we've been following for years. The chairman of Icahn Enterprises is here with us right now. Carl Icahn, welcome.
Thank you.
It's great to see you, and it's especially great to see you, Carl, because I want to tell everybody it's your birthday. If I'm not mistaken, Carl, you're 86 years old today, and you are celebrating your birthday with us, which we're undoubtedly quite happy about. Thank you.
Thank you. It's an honor to be doing it, Eric.
Carl, you like to get into it, so that's what I'm going to do. You predicted months ago that Fed stimulus would metastasize into inflation and fast become a problem for policymakers, for the economy, and of course for investors as well. This is a movie that you've seen before. You've seen it several times before. Carl, how does the movie end?
It doesn't end happily. I've seen God knows how many bear markets, and they're similar in one way. It's a sad thing, and a lot of people lose a great deal of capital. And I am not predicting, though, Eric. I'm not predicting that we're in a bear market. I'm not predicting that this is going to end, sort of this euphoric atmosphere. But I am predicting this, that, and it's not much of a prediction, I guess, but sooner or later, a situation like this is going to end relatively badly. Some less badly, some more. But you can't keep printing up money and printing it up and printing it up, because you get what you have now that you can't control. The government can't control inflation. It controls it only what they're doing, what Volcker had to do. You know, bring interest rates up to 18%. I remember those days. It was unbelievable. So I think that's going to happen, but I'm not here to discuss. I'm not a macroeconomics guru, and I just look at simple facts. That's all I do. Simple facts. And the simple fact here is the tension between inflation and printing up money can't continue to exist without busting open.
You say, Carl, that you're not predicting a bear market, but this is going to end in an ugly way. What's the difference?
Okay, well, I'm not predicting a near-term bear market. Nobody can predict what's going to happen next week, next month, maybe even next year or two. You really can't predict it. Too many variables. The whole political scene, the whole question of the presidency. But on a big picture methodology, you can look at it and say, it's simple. You can't, I think it's economics 101 in high school. You can't just keep pushing out money. You can't just keep giving away money and giving away money, because that money will definitely lose its worth, like anything else. If you make too many widgets, then the widgets lose their worth. So here's what's happening. We keep putting out money. The Fed keeps pushing it out there. And that's great for a while. I mean, that's great. It's like, makes you happy. But, and at times it's certainly needed. But now you can't, that party has to stop. And sooner or later, what's going to happen is and you're having it already now, the manifestations of it is rampant inflation. And it's not there yet, but it has to be controlled. And it's not something that you can wait to see if it happens, because I've seen that in the past. You wait too long, maybe. But I'm not here to say the Fed's doing a bad job. In fact, I think the Fed has done a pretty good job over the last few years in sort of saving the economy. So that's not the issue. But the issue is, if you're asking me to predict something, I'm only saying, and it's not saying very much, I guess, that over the next 3-4 years, or maybe a lot sooner, you are going to see this whole thing hit the wall in one way or another, and it's not going to be a pretty outcome.
Carl, no, go ahead.
Yeah, but I'm not saying it's happening now. In fact, right now there might be a lot of arguments on the bullish side right now. You know, these companies are flush with money. They may be doing a lot more buybacks. You know, the buybacks last year, I think, added $1 trillion to the economy. So there could be a lot of bullish things that you could say for the near term.
Carl, is there an icon playbook for inflationary times? Are there things that you want to own at times like these and things that you're actively avoiding at times like these?
Yeah, look, I mean, over the years, the paradigm that I find the best for investing, and it's obviously most people can't do it, is activism. And going into companies where the stock is selling cheaply for a number of reasons. And if we can get in there and we can do something, we can help that company. And sometimes we come as uninvited guests, but a lot of companies in this country are terribly run, just terribly run. And by the way, in my mind, that's the reason for the problems that we have today. You have companies that the CEOs are making 10, 15 million a year, and many of these guys are not capable of doing the job, with many, many exceptions. I want to say many exceptions, many very good CEOs. Good CEO is worth his salt, and you pay him, and if things are going well, I don't mind seeing that guy making a lot of money because he's producing. But there's so many bad ones and so many bad boards because the boards aren't doing the one job they're paid to do, which is make that CEO accountable. So those stocks go down, things get into a problem, we come in, and that's our paradigm. We try to clean it up and just change a few simple things, or maybe more than a few simple things. And over the years, we ended up even since 2000. If you bought our stock, IEP, which is sort of a surrogate for what we do, we have other money, but that's what you could look at. If you put money into the company that and bought that stock, you made today. If you look back, you made. If you reinvested the dividends, you made 1,900%, and I think the S&P is only 600%, 500% that you made. So the proof of the pudding's in the eating. You did very well by following and doing this, what we do. There are ups and downs. It's a bumpy ride. Sometimes we lose for a few years. Mm-hmm. Sometimes secular changes. But the issue I'm trying to make is that the reason we're successful is because you have this very strong problem in our economy today. There's no accountability. And while I believe, maybe I'm jumping ahead, but answering some questions.
You are, in fact, you are jumping ahead. And before we come back to activism, and we will, Carl, I want to introduce you to a colleague of mine, Taylor Riggs, and she has a question for you as well.
Thank you, Eric. And Carl, it was so fascinating. You echoed similar comments when we spoke last May. And you talked about waiting for stocks to become cheaper, for you to really begin to look at them, to begin to enter. And I am curious if that process maybe already started for you in January, and if there were stocks where you looked and they were cheap and we've started to already see some of that volatility, or is it still yet to come?
Yeah, you know, it's more, when you say the stock is cheap, it's cheap for us when we think there's hidden value in the company. It's not that we're buying it because the market is cheap and the market's good, because we keep things hedged. We had that record, and we were hedged all along in bull markets, meaning that we have shorts on the S&P, for instance, or other shorts. So we buy what we think is good, and maybe in that industry we short a stock. I try to stay away as much as I can, and I've learned this lesson the hard way. Stay away from predicting the near-term movements of the market. I read all the guys, and they all have great ideas. But I tell you, I think there's just too many variables to tell you and even talk about what the market's going to do next week, next month. So we just find companies that we think are valuable if you do certain things, where you have poor managements and you can just uncover the hidden jewel, for instance. And we've done it a number of times. You know, you think back, and some of them are obvious. Sometimes it takes a few years to make it work. But
Carl,
you look. Yeah. Okay. Go ahead.
You know, I was just going to say that in addition to obviously, you know, putting up an extraordinary track record as an activist, you are a pretty good trader. You've been active on occasion, right, in commodities or derivatives such as the CMBX. And I'm just wondering, at a time like this, given the conditions that you described, whether you have any trades like that on.
Yeah, well, the CBX is a good example. The CBX, it's a complicated story, but
the mall short, as it's called.
Yeah, it's sort of a mall short. So to make it simple, it's a little bit like 08. It's analogous to 08, and that's why it's very worrisome. Just like all those mortgages fell apart, in the CMBX, you have like $25 billion invested in 25 deals. But the real, it's almost, that 25 billion, believe it or not, is a tail wagging the dog, because you could do a CDS, which is a very complicated derivative. But in simplicity, it's buying insurance. So you go in and you're buying insurance on those deals. So basically, you're buying insurance on a mall. Or it's not on one mall, but I'm just making an analogy. And what happens is, this market, I believe, and I say this, and I think it's maybe being popular, we have that insurance. We made a fair amount of money by buying that insurance on the malls. But I believe that market is manipulated quite a bit, just as in 08. And maybe to some extent it's legal, maybe not. So you have these large mutual funds that sell that insurance, some of them, not many. And then they go out and they sell insurance, and it's called a CDS. And I believe, well, to begin with, I don't believe that they disclose the risk of that CDS. That CDS is extremely risky. And there are not many funds that do it, but there are a few that specialized but do it. And they actually deceive the people buying it by telling them, and not disclosing to them, the risk there is in that. I mean, that's why we're making money on the insurance, because there are a lot of people, Mrs. Jones out in Iowa somewhere, think she's buying treasuries. Because what they do is tell people, you know, this is similar to treasuries. And then what they do, so then when the insurance comes due, so say you own the insurance, I make it simple. When the insurance comes due, they don't want to pay the insurance. So it's analogous to having insurance on health. Let's say on your health. You have insurance on, and you get sick. How would you like it if the insurance company basically, and I'm putting it very bluntly, pay off the doctor or threaten the doctors to say the guy's not sick, so they don't have to pay the insurance? And that's what is going on today in certain cases where we're looking into, and we have evidence that that goes on. And we're going to fight in that. So that's an area where we think there could be a lot of manipulation. But okay, but that's a sort of specialized thing. And
very specialized. But as you pointed out, in that short position that you had via the CMBX, you made a lot of money. I remember seeing a report, in fact, that we published back in 2020. You'd made more than $1 billion. Are you still short the CMBX?
Yeah, we're still short it. We didn't quite make $1 billion, but we made maybe 600 million, something like that, 700 million, which is great. I'm not crying about it, but I just want to correctly.
I suspect not.
We still believe. In other words, some of these malls have come better. It's a real complicated issue. I'm just talking about where you see manipulation happening, similar to what happened in 08. I see a similarity.
I want to ask you, Carl, about McDonald's. I'm really intrigued by your dispute with McDonald's. And I'm not sure how many people are familiar with it, but what you've effectively done is make an issue of animal welfare. You're fighting for better treatment of pigs, and you're fighting with the world's largest fast food chain. How come?
It's not that I'm picking a fight with McDonald's, because McDonald's is not a company that we own stock in. We own 100 shares. So it's not that we own stock in it or trying to make a profit there. But over the years, I don't do much about it. But for one reason or another, I really do feel emotional about these animals and the unnecessary suffering you put them through. They take these pigs, and a pig a pig has a good brain, and it's a feeling animal. And they take these animals, and for no reason, I say no reason, put them in these gestation crates now. They didn't used to do it 20, 30 years ago. We've become worse, not better. It's almost sadistic. You put them in this crate for its whole life. A crate where the pig can't move. It just can't move around. And they could easily not do it. So 10 years ago, my daughter worked for the Humane Society, and she called me up and said, look, Dad, and she knows I hate to see a suffering of animals. I was fourth in my regiment in the Army shooting a rifle. So I'm a good shot. I get invited to go hunting. I never went hunting in my life. I just hate to see suffering for no reason. And I'm not trying to be holier than thou or sanctimonious, but I said, hey, wait a minute. That's terrible what goes on, and they won't call you back. So they said, they'll call me back. So I called the CEO back. I said, they're going to call me. And they called me up, and then I discussed it with him. We said, Mr. Icahn, we agree with you, Carl. CEO said, I agree with you, and we agree, we're going to try to stop this, and we will make a pledge that within 10 years, there'll be no gestation crates. The Humane Society accepted that, so I probably would have been tougher on it, but we did it. And now they just never delivered. They did a little something, but never delivered. And so they called me up again. And I was really teed off because here they had promised this and I didn't even know that they didn't deliver or anything like that. So we're telling them, hey, look, you guys promised that you are going to not buy the trim as part of this if it means that you're buying it for those that those that produce the pigs, so to speak, in these gestation crates, so keep them in the gestation crates. So that's what's going on. And we are probably 90% there of putting up a slate. We're not going to fool around with them anymore. Putting up a slate and say, hey, you got to live up to your promise and you got to do this.
Seriously, you're going to wage, this is important enough to you that you're willing to wage a proxy fight over it with McDonald's.
Put up a few, slate a few people and wage it. I really think, though, it's getting this story out because I think it's obscene with chickens, where they don't have to suffer. And it's almost, they're out dancing. The CEO of McDonald's makes over $10 million a year. Everybody's having a party, and maybe he's operating it well. Well, why the heck can't you just do something? And they say they will pay a premium for it if it's not done in a gestation crate, in fairness to them. And we are talking to them. And we intend to do it with in other areas where there's unnecessary animal suffering. I didn't realize how bad it was myself until my daughter really showed it to me. She's a vegetarian. She's into this stuff. And my son, too, feels strongly about it.
Other areas opens up, I don't want to call it a Pandora's box, but Carl, the catalog of animal abuses by the agribusiness industry is enormous. I mean, I'm sure you're familiar with the horrifying footage from poultry farms, right? The way they treat chickens. There's some similar stuff that goes on with cattle. And there's other stuff, I should add, that goes on with pigs. What does this mean? Tangling with Carl Icahn on a matter of, who sits on the board is one thing, but this is a big issue, and I'm just curious to know whether you're willing to put your money and your word and your actions behind. I just want to get a sense of what you have in mind.
We're going to fight it as much as we can. It's a movement that people now feel strongly about. And it's unnecessary to have this suffering, really unnecessary. It's not something where you can say, well, it's for the good of humanity and we got to do, and even that is very unnecessary, all the medical testing they do. But at least there's an argument in some cases that you have to do it. Here, you don't have to keep this pig stuck in this gestation crate. You could change it. Of course, they have arguments of why they do it. But there is no argument for this suffering. It just gets you angry. The pig has to spend his whole life in this crate, or now they say they take him out for a little bit and not be able to move. Look, the pig's going to get killed. Okay, I'm not being holier than thou and say, well, you can't eat meat because the pig wants to live for years. But, okay, the pig is killed, but doesn't have to suffer for 4 years and then get killed. It really gets me upset when we talk about it. And I'm not being sanctimonious about it, but it's something that I think I can help to some extent, ameliorate it to some extent. And I think we're going to do it. But that doesn't take away from what I think I do best is picking these stocks and creating value for all shareholders. We create, just to digress, we created $1 trillion of value for all shareholders. I'm not going away from that, but this is an area that
Well, let me put it this way. I can think of a number of animal rights activists who would love to have Carl Icahn in their corner waging proxy battles with the likes of McDonald's and others. Carl, but I would like to introduce another of my colleagues, Romain Bostic, and he has a question for you as well.
Carl, I want to talk a little bit about commodities and get your thoughts on what some people say is sort of a new super cycle that we're seeing, particularly in the energy sector and particularly with some of the tailwinds that we're seeing out there because of the shift, or at least, I guess, the dabbling right now with renewable energy sources.
Well, yeah, it's a huge question, and you could go on for hours and hours on it. We are involved in Occidental, as you probably know, and we have a lot of that. Oh, and that has got the benefit of this upcycle now. It's sort of amazing, isn't it, that less than I think March, a year ago March, so it's less than a year, you could buy, and we have a refinery, and we actually bought oil for minus $30 a barrel. That's how bad it was. And now that same barrel, the same thing has gone up, WTI has gone up to over 90. And I'll tell you, I don't think there's anybody in this country smart enough to have made that bet. You know, would make the bet that I think anybody would give you 50 to 1 odds that if you tell them when that oil was selling for negative, they paid you to take the oil because they couldn't store it. And we bought it in our refinery, not much. I wish we had bought more, but we couldn't. But, you know, for one reason or another, we couldn't have the storage space. But wherever we had storage space, we cleaned it up and took that oil. And I think you would have been 100 to 1 odds. You would have given somebody, if you said, well, before March of next year, you know, in fact, in February, that same oil is going to sell at over 90. So it's how crazy the commodities are. So we own stocks in them. But I'll tell you, and sometimes we trade the oil market because, you know, we own the refineries and one thing I'm very bullish on, and obviously people know this, that on LNG, for instance, Cheniere. I mean, look how great that company's done, and that was activism helped out a lot. We got in there, and the CEO was changed, and the new CEO is doing a great job, and the stock has gone up tremendously. This LNG, for instance, I'm sure you think is really interesting, but that you might have predicted. You might have predicted that the world needs energy, needs electricity, and where is it going to get the electricity outside of this country? So we make all this gas, and if you could turn it into LNG, liquid natural gas, and you turn it into that, you're going to be able to, and now it's come to fruition because you're going to be able to produce electricity for Europe and Asia and what have you. So I'm certainly bullish on that for the long term. And but trading commodities is not my thing. Every time I just try to trade them, without just a long-term thought, it's very hard to do it because there's so many, again, variables, and suddenly it hits you that you're wrong. Oh my God, this has happened, that's happened. And in the stock, you say, I don't care if I'm wrong, I'll just buy more of this company, I'm an activist, I'm gonna make it work. But suddenly, one reason or another, I remember the days we owned Freeport. We made a few bucks on it, but not much because we just couldn't hold on. There was so many factors coming in at you from Indonesia and whatever that it's not a game for me. But some people, I think, do well with it.
Carl, could we go back to activism for a moment? And for those who are just joining us on Bloomberg Television, on Bloomberg Radio, on YouTube, and of course on the Bloomberg Terminal, we're speaking with Carl Icahn, the billionaire activist and chairman of Icahn Enterprises. Carl, the SEC has proposed a number of new rules that, at least on the surface, threaten to thwart activists like you. And I don't want to get into a catalog of the rules and their prescriptiveness, but you know, it would force you to disclose stakes faster. It would force you to disclose economic interest through derivatives and not just common shares. It would expand the definition of a group. I want to know what you make of these proposed rules and the impact that they'll have on activism.
It's interesting. I mean, there are rules that the SEC are promoting that I think are sort of necessary without getting into details. I think there are abuses, like I just said in the CMBX area. There are abuses by even these mutual funds and even these investment bankers and guys I know and friendly with. However, the one that I'm adamantly against, and really, again, I'm saying not because it relates to me, which it does relate to me to some extent, but in a way, in a very ironic way, it might even help me. But what they're doing now is throwing out the baby with the bathwater when it comes to activism. Because I completely, totally believe this, that this country, one of the real problems of this country, I said it before, and maybe one of our problems is that we have great corporations, but many of them are terribly managed. And that's one of the problems we have. We have the wrong guys running a lot of these companies, and there's no way to get rid of them. There really isn't, because there really is no corporate democracy today. I mean, corporate democracy is an oxymoron, because you really don't have fair votes. I mean, and I'm not saying something people haven't almost agreed about, that you really, to go in and fight a company, it costs you a great deal of money. First of all, they beat you up with PR. But I've been through it, so that's what I'm saying. These rules don't affect me as much. They beat you up with PR. It's more of a feudalistic system, to be euphemistic.
Which is the rule specifically that you think would affect you and perhaps other people too?
The rule that they're trying to push now is the 10-day rule, where if you buy stock, so an activist wants to accumulate some stock. He says, okay, I'm going to face all these problems. I'm going to go in there, and I'm going to have to put up with the PR. I'm going to have to spend a great deal of money proxy fight. I mean, in a political election, you put the guy in jail if you're the president and you used the money, the government's money, to go fight in the political arena. Here, you have to do all these things. So, but the one thing the activist might be able to make money with is he buys stock first, and then he gets to 5%, and then they let you buy stock for another 5-6 days, so you accumulate some stock, and then when it gets out, if he has a chance, or he gets the company to sell themselves or do all these things, he makes some money for all the work he did. Otherwise, why should an activist even do it?
I see.
A little, and then why
so
would he
it's
ever do it?
it's disincentivizing activism. Have I got that right?
Disincentivizing something that should be done now. I do agree, because I want to be fair about this to the SEC. I do agree with some of the criticism, and so the criticism basically is some guy goes in and says, "Hey, look, I'm going to be real smart about this. I'm sort of a known guy. I'm going to buy this stock, and you know, I'm just going to get it there. Now I'm going to get the PR out there." And some of these activists do that. They get PR, they get articles. Oh, I just bought the stock. Isn't that wonderful? And the stock goes up, and then he sells it. And I think that is a legitimate criticism.
The short-term game, in other words.
Short-term game. So I would suggest, and I'm going to do this, I'm writing a paper on it, that it's fair to say that the activist can't make that short-term gain. He has to disgorge it. In other words, if he's an activist, he's buying it for the good of the shareholders, he's saying, and to some extent for the good of the company. I'm going to wage a proxy fight or whatever. He has to keep it for a certain amount of time, as you have in many cases with boards, and he has to keep it with a certain amount of time. But let's say he buys it, and the stock, and he gets that extra 5 days or 7 days, and he accumulates some stock, and then the stock does go up because he bought it. At least he's going to make some money if the company does go out and sell itself or does other things that he suggests. So otherwise, what this rule is going to do is actually discourage activism even more than it is discouraged today. And just to add to what I said before, I think that's a very bad thing for our economic society, because right now...
You need activists.
Yeah, you absolutely need them more and more now. Right now, we have inflation, we have badly run companies that are not accountable, and the boards really don't do their job. So you do need activism, and this is going to be almost the last nail in the coffin. There are a lot of nails in that coffin already. You know,
Carl, I know I want to move on to ask you a question, and I'll preface it by saying this. I know how much you don't love talking about politics, but I do have to ask you about somebody whom you know well, Donald Trump. Everybody knows that you supported him, you know, in his presidential campaign. And on occasion, you functioned as something, I would say, as something of an informal advisor. You and he talked about some issues together. Because of that, people would like to know, and I'd like to know, if he were to run in 2024, would you support him?
Yeah, it's a good question, and I would have to think about that quite a bit. I think Trump did a lot of good things, and I disagree with him on a number of things. And you know, I'm obviously have a big business to run and spend a lot of time on it, and I wasn't able to go down to Washington a lot. In fact, I don't think I ever went down there except for the inauguration, even though I was invited down there by Donald. I basically, I'm not a guy that gets into politics. I think Donald's done a lot of good things. He's done things I disagreed with. However, I will tell you, and I've been around a long time, I've never seen Washington as confused as it is today.
Who do you blame that on?
The history book. I look, it's obvious. I mean, I don't want to get into politics here too much, but I would say that right now, I think that we have just made tremendously poor decisions in the last 6 months. I mean, go from Afghanistan to other political decisions. I really don't want to get into too much. I don't want this to be a political thing.
No, I understand, but I framed the question very narrowly because I didn't want it to become an expansive discussion about politics. But you're not decided, it sounds to me, if you would or would not support him in 2024. Does that depend on whether he does or doesn't, or who's running against him?
One thing, the way it is today, there's no question in my mind, I would support any Republican that's nominated for the presidency. The way this plays out today, and I would support any Republican candidates in November, because right now, I'm not saying people that you don't know this, but it's a rudderless ship right now. So I would do that. So I would support anyone that's doing it, but I'm not saying that, you know, Trump is necessarily the right guy. I'm not saying he's the wrong guy. I just, you know, haven't spoken to him for quite a while, and not that I wouldn't speak to him. I mean, you know, we're friends and all, but I haven't spoken to him at all. And I'm not sure it matters a hell of a lot who I support anyway. So,
well, one of the things that's fueling the disagreement in Washington that you make reference to is inequality, and you've raised concerns about income and wealth inequality in America, and you've connected the inequality problem with compensation in many respects. CEO compensation, compensation for bankers that you consider overblown relative to, you know, what they're contributing. You've probably noticed, Carl, that CEO compensation and compensation in general on Wall Street is going through the roof. There are some bank CEOs who are making upwards of $30 million a year. And in fact, there are two current CEOs on Wall Street who are billionaires. What do you make of that?
I just said to you before, there is no accountability in a corporation. So by definition, you're going to expect that. If you were running your program here, you do a great job. Okay. But if there was no, and if it was up to you and you ran all of Bloomberg, hey, if it was up to you, wouldn't you give yourself raises and raises and raises? I mean, the boards do nothing. If the board does nothing and they say, you go and say, I'm going to leave, buddies, if you don't give me a raise, well, of course. So you have no accountability at these companies. And look, I've lived it. I honestly don't think that the SEC, that I am not criticizing the SEC because they're doing some stuff they should be doing. A lot of it they should be doing. But I am saying that if you really understood what went on in these companies, which we do, or I do, you would be saying, you can't believe it. I mean, maybe to jump ahead, and I think maybe it'll interest some of your shareholders, we're in a proxy fight now with Southwest.
Sure.
Southwest Energy. And that's the quintessential example of what I'm talking about. You got a board that's basically just a do-nothing kind of board.
Well, that's a situation where I'm honestly, Carl, I'll ask you because you raised it. You've played some pretty big cards already, right? You've proposed dumping the entire board, if I'm not mistaken. You're opposed to their purchase of Questar pipelines and the manner in which they're financing it. You've made a tender offer for the company. What's next? How do you win?
I'm only saying to you that it's an example. I mean, we are making that tender offer, and we believe it'll be successful. We believe we're paying $75. The stock would be 61 or something if we weren't there. It's now 66 or something. And it's a good test. But we think we met every condition you need for that tender offer. And they keep coming up and say it's conditional. Well, it's conditional on the poison pill. But I mean, the simple strategy is, if we have that tender offer and they got the poison pill, then if they vote us into power, not us, but we have an independent board for the most part, goes into power, they drop the pill. They say they will, then we can pay them. They have a condition. There's a condition where there's regulatory agencies in 3 states. But I don't think we violated any of the rules of those regulatory agencies.
So it's just a matter of time, you think, before you emerge victorious?
Look, I'm sure litigation, but I believe it's a matter of time. But about that tender, we are just talking about the tender. But to get back to the original point, the country, and you making the point very well, Eric, that there is no question that the whole system is almost, it's sort of a vicious cycle where each group that's in power wants to, help the other group because they help each other, and therefore you have this great overpayment. But that's not even the real reason that you have the problems. The overpayment is just a manifestation. We have great companies. These companies can produce. They're not producing because you have bad managements and boards that will do nothing about it. And it takes guys, and I'm not trying to praise myself, but it takes guys like us, activists, to go in and shake them up. And
it's your business.
The reason that the proof of the pudding is in the eating. If you bought the stocks we bought, over the years, we made over $1 trillion for shareholders just by increasing and enhancing value. Not because we're geniuses, not we even saying we're great operators, but just by cleaning up the mess.
I'm curious, Carl, to know, in the course of waging those battles, who you go to. Who's your go-to guy on Wall Street? I asked you about bankers and banker compensation, but I'm equally interested to know, when you want somebody in your corner, a banker, a CEO, Wall Street CEO, who do you turn to?
Yeah, I mean, we have a couple of favorite bankers. I mean, to raise us capital, but basically we use the banks not so much for strategy.
No, I realize you use it, but I want
to raise capital, and we've used. Look, we found in one deal we found Citibank to be very, very effective. Jefferies is another company that's very effective in raising capital as far as we're concerned, and we work with them. And while I think we overpay for all this stuff, it's not outrageous with them as it is with some of these companies. Some of these very high gilt-edged companies, what they charge is completely outrageous. I mean, and I've said it. I agree with you completely. That this whole area is completely outrageous. Look, I believe that if a CEO is really good and he's got his stock way up and the shareholders are making a great deal of money, okay, he does deserve to be compensated because maybe he could go somewhere else and do the job. He did a great job. So I'm not saying that. Or somebody risks his money. He goes into a deal. He buys a stock. He helps that company or whatever. But he risks his money. He deserves it. But these guys, these CEOs and these guys, I mean, it's almost like on a comedy show. The CEO does a terrible job, so his options don't come in. So he complains. He says, "Hey, I'm not making money on my options. So, board, what you got to do is lower the striking price of the option so I can make money." He's done a terrible job, but he says, "But hey, you got to lower the price of the option," and the boards do it. And we jump up and scream about it, but what the hell can you do?
Speaking of comedy, those who watch the HBO documentary will see a clip of a routine that you once put on at Caroline's, the comedy club here in New York City. But I also mentioned the documentary, Carl, because I watched it last night, and it left me with 2 unanswered questions that I'd like to get to before you and I wrap up. And the first concerns succession at Icahn Enterprises. It's not exactly clear coming out of that movie whether your son Brett will or won't take over for you at Icahn Enterprises. Have you decided?
I don't even think it's a decision. I mean, what Brett said is sort of true, and I think he summed it up. Look, as long as I'm healthy, I enjoy what I'm doing. I'm an old guy, but I haven't lost my marbles, and I think I'm real good at what I do. I sort of over the years perfected what I do, and I enjoy it. So I don't want to, give up the reins, and maybe I could get a few things done in different areas. But after that, Brett is a very competent guy, and I think it's going to work out that but Brett is, I don't think, and he would say it himself, he's not an operator so much as somebody that goes out and sort of does what I do. And by the way, I'm not an operator either. In other words, I don't go in and take any credit for saying, I'm going to this company and I'm telling you, you should build a building here, or we should do that. We get into those companies and make sure the operator is producing the numbers he thinks he'll do or that he should be doing, and helping them with M&A. We're really good at M&A. So when they want to raise money for something, we look at that and say, that makes sense, let's do it. And then we get the money for them and that kind of thing. And that's what Brett is very good at. And I think, forgetting that he's my son, I think he'd be the kind of candidate I would have to be the successor. So, and obviously, I think Brett himself would admit or realize it and say it, that he's not the guy that's going to be the guy, the hands-on guy at the different companies to operate them. But that's not what we do. And we have good guys running the companies, or we
only on rare occasions. The second question I have, Carl, for you is about legacy. This unanswered question, if you will, from the documentary. You signed the Giving Pledge, and in the film, Bill Gates says that means you've committed to giving away more than half your wealth. I know from Mike Bloomberg that giving away many billions of dollars is challenging, right? It takes thought, it takes time, it takes effort. And here we are, as I mentioned at the outset, it's your birthday, you're 86 years old, and I'm kind of curious to know, when do you start giving away a whole lot of money?
Well, I mean, we just gave another $40 million to Mount Sinai toward the, we have that Mount Sinai hospital, and then, we have the Icahn Stadium. Over the years, we've given away, and that's sort of interesting, we've given away money for these colleges, and I can name a few, Choate and all, that they're buildings. Princeton, we gave a building to. So we have given away a lot of money where I think they probably like it. I don't personally get too involved. A lot of guys like to go on the boards of these things, and go on the boards of the institutions. I mean, and honestly speaking, the only thing that I'm getting involved to, because I can help it, is this animal rights thing, where I think there's a way that I can be really helpful to seeing that happen. Because I think that's a situation that's just horrible. It's obscene. You got these companies making all this money and these animals just suffering for no reason. Okay, I'm not going to keep repeating it. So I think that's something that, I would, the foundations that we have would be much more involved with this animal rights thing. And obviously we have a lot of money, so we'd be into other things. And the foundation itself is still, I mean, there'll be certainly enough money if I get out of the business for any reason. IEP will still have, I mean, it's not going to affect the amount of capital they have today. And I mean, there are public companies, so the money that they have today is not going to be effective, nor would I want that stock sold. I think I'd like to see that as a legacy to continue. And I think if you ask who's the guy that's going to run it, I think Brett has learned enough and is quite fit to do that. And I say that the operation would continue very much in the way it is now, where I don't really get in, nor would Brett, and tell these guys how they should operate the company day to day. But hold their feet to the fire if they're not producing, unless there's a reason not to. I mean, if you have a terrible recession, you can't blame somebody for not making money. So I think that's where it's going.
Well, as always, Carl, we can't wait to see what you do next because it's always fascinating, and clearly Brett will be with you doing that. I'll say happy birthday once again. It's always a pleasure speaking with you. Carl Icahn is the chairman of Icahn Enterprises. Thrilled to have you here on Bloomberg Television, Bloomberg Radio, YouTube, the Bloomberg Terminal, Carl. I look forward to our next conversation.
All right, of course, that was Eric Schatzker with Carl Icahn turning 86 today. Check out that full conversation. You can listen to it, watch it at Bloomberg.com.
Well, let's get a check of the market. Standing by, we've got Charlie Pellet. Hey,
Thank you
Charlie.
very much. 15 minutes to go ahead of the closing bell. The Dow lower right now, S&P higher. In the green, up by 10 points. NASDAQ lower by 2. A couple of minutes ago, we did have the Dow, the S&P, NASDAQ all advancing. Indeed, choppy session as I speak. All three now turning positive. We've got the NASDAQ 100 index higher, also a little changed, up by 3 points. S&P up by 0.2%. 10-year yield 2.02%. Gold, spot gold up 1%, 18.71 the ounce. And West Texas Intermediate crude down 1.3%, 90.86 a barrel. Icahn Enterprises Chairman Carl Icahn wrapping up a wide-ranging interview here on Bloomberg Radio. You heard him touch on a number of topics, including his strategy for getting involved in companies, animal welfare, and the markets. And here's what he had to say about the inflation outlook.
I just look at simple facts. That's all I do. Simple facts. And a simple fact here is the tension between inflation and printed up money can't continue to exist without busting up.
Icahn, by the way, is 86. It's his birthday today, and here's what he had to say about succession at his company.
As long as I'm healthy, I enjoy what I'm doing. I'm an old guy, but, you know, I haven't lost my marbles, and I think I'm real good at what I do. You know, I sort of over the years perfected what I do, and I enjoy it.
And again, recapping stocks now higher across the board with the S&P up 14, higher by 0.3%. Now a look at world and national news as we head down to the 99.1 newsroom. Here she is, Nancy Lyons.
Thanks, Charlie. U.S. Defense Secretary Lloyd Austin is in Brussels. He's hoping to reinforce America's commitment to its allies as Russia still masses along Ukraine's border.
This is a very challenging time. Of course, the alliance has only grown stronger here.
Defense Secretary Austin, so far the West has seen no sign of a promised pullback of Russian troops, despite the Kremlin saying it is withdrawing from the border. President Biden is holding a meeting today with German Chancellor Olaf Scholz to discuss the latest developments. As states one by one announce the end of requirements to wear masks or to show proof of vaccination, the CDC is still studying whether and when to join in. Bloomberg's Irv Chapman reports.
Dr. Anthony Fauci summed up the progress.
The dynamics of COVID-19 outbreak continue to point in a sharp downward direction.
CDC Director Rochelle Walensky reported 40% fewer cases than last week.
We want to give people a break from things like mask wearing, and we are all cautiously optimistic about the trajectory we are on.
Dr. Walensky said the decision will be based not only on numbers of new cases, but also the ability of hospitals to cope, not only with what is now 9,500 new COVID patients a day, but also to care for heart attack and accident victims. In Washington, Irv Chapman, Bloomberg Radio.
President Biden is ordering the release of Trump White House visitor logs to the House committee investigating the riot of January 6th. It's another rejection of former President Trump's claims of executive privilege. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 12 minutes left in today's trading session. We've definitely seen a reversal, and we are hovering near our best levels of the session. So we've gone from red to green when it comes to the equity trade, and that is following the latest Fed minutes from the Federal Reserve. It was that January meeting. I really think the takeaway, and our Markets Live blog has been just great on this, that basically, there was nothing there that made investors think that the Fed is going to be more hawkish than it was already anticipating. Keep in mind, the market's already pretty aggressive about what the Fed may do come March.
More hawkish is, I think, the key there, Carol, right? Not much new in there in terms of new hawkish signs in the Fed minutes. Let's chat all about it, that and more, with Jimmy Lee, the founder and CEO of the Wealth Consulting Group. $2.7 billion in assets under management. Jimmy joins us once again on the phone from Las Vegas. Jimmy, how are you?
Great. Great to hear from you guys.
Yeah, it's good to have you back with us. Help us make sense of this market right now. We not just have investors trying to figure out the Fed's next move. We have investors concerned about the hottest inflation print in 40 years. And then we have geopolitical tensions on the border of Russia, Ukraine. Help us make sense of it.
Well, I think until we get past the Fed meeting in March, we're going to see some days where we get some wild swings in the market and volatility. And so, until the Russia-Ukraine situation settles itself out, and we'll know that pretty soon, I think, that's the one thing besides the Fed meeting that's coming up where people are speculating whether the Fed will raise rates by 50 basis points or less. I'm in the thinking that it's not going to be 50, but there's speculation about that, and you're going to have people on your show and commentators that think both ways. So I think the market, the economy can absolutely stand 50. So if that were to happen and we get some short-term volatility from either that or an invasion into Ukraine, I still think I'm constructive on equities for this year and the economy. And I would use that as a buying opportunity if you're a stock investor.
Yeah, what's interesting on the equity side of things, right, Jimmy, is that right now a lot of investors are a lot more aggressive in their thoughts about how aggressive the Fed will be in raising rates. We were talking with our Kathleen Hayes in terms of the balance sheet. There's a very big difference, and that's still in question how the Fed approaches this. And there's a difference between letting a runoff or actually actively selling assets off the balance sheet. There are still a lot of unknowns. We know the Fed's going to raise rates. At this point, it's aggressive. If the Fed is a little bit more dovish, what would that mean potentially for the equity markets? That could put it in a really good place.
I agree, and that's actually what I think is going to happen, Carol. I think that the hawkish signaling that the Fed has made absolutely gives them some room to back off of that statement or those statements. And the people that are predicting 7 rate hikes, I think, are going to be wrong. And so I think the supply situation gets better first. And then, as they've said, they're going to be very data dependent and very flexible every single meeting. And I don't see them raising rates as high as some people think. And I think the long part of the bond market agrees with that. So you don't see the long end of the market really going up that much. And I think that the bond investors on that side are disagreeing with people that think the Fed is going to be very hawkish.
Well, we saw the bond market just come in just a little bit on yields. I mean, a hair, And what's interesting is in that FOMC minutes that, again, we heard from those members that price pressures would moderate and the default setting of that, the issue will work itself out, Tim. That is still there by members of the FOMC.
Yeah. Hey, Jimmy, I want to dig into what you were saying about this being a buying opportunity between now and the next meeting of the Federal Reserve. What to you is sort of a bottom for the current cycle that we're in?
Well, I think we've seen a lot of support at around 10% on the S&P 500 during the days that we saw it cross intraday. And I would see that. I would see, let's say, for example, if we get an invasion into Ukraine, maybe it could go down a little further. If the Fed raises 50 basis points, maybe we could see hitting that 10% number again. But I would see I would think that we would get aggressive buying at around that 10% number again. And so, I'm bullish as long as earnings continue to look good. And I think earnings can look better in the latter part of this year if costs come down a little bit. And so if the shortage on the supply situation improves a bit, and we're already seeing some signs of that, by the way. One of the indexes we follow is the shipping index out of London, and costs have come down by like 2/3 over the last month or two. And so certainly the supply situation, you hear lots of different stories, but I think the supply side and the expense that companies have to deal with will get better. And so if earnings can hold up partially due to that and also the strong consumer, I think that equities from here on out, if we end up with high single digits for the year, would be very good.
So, Jimmy, you think inflation has peaked?
I think there's a good chance it has. And I think that, yes, I do. And I know it's a little bit of a contrarian view, but I believe that the Fed ultimately could be right that it was transitory, or it will be transitory.
Wow, it's a
certainly be.
Is it? You're like the only one. It might be, relatively lonely in that corner.
But people have talked about peak inflation.
They have, but we're still seeing. Yeah, they have, but it hasn't really turned out that way.
Well, the data points.
Yeah, that's the problem.
It's a tricky time. So I know you don't talk stocks, sectors. Where should we be though at this point, Jimmy?
We're using a barbell strategy, and we still believe that it's better to be in some of the more economy opening cyclical sectors. And so we're overweight energy, financials, industrials, materials, but I think people will go back into growth stocks, but quality growth stocks. So companies that have good earnings. Obviously, the companies that have been hit the most with the highest valuations that don't really have great earnings. I don't know if investor money will flow back into those as aggressively as they may some of the mega cap stocks that investors have been invested in for a long time. Also, for listeners, in past Fed tightening cycles, stocks have done very well. So equities have been a good asset class during tightening cycles, and actually growth has beat value in those past time periods. Although this time around, I think it's dangerous to say, but I think it is a little bit different in the sense that I think the value sectors will be doing very well, and also it's important for investors not to be too underweight overseas. And so I think international markets will do better as well.
Yeah, we've heard that too. Although, what's interesting, and I guess we'll have to watch the economic data points, the Fed in their minutes also talked a lot about Omicron and its potential to weigh on output, and also talked about future variants. And we know our reporting tour, I think of our Michelle Cortez story over the weekend, that we're not out of the pandemic, and we're not out of the pandemic until everybody's out of the pandemic. So that continues to be something, Jimmy, that certainly can impact the trade and where the opportunities are.
Yeah, and I've got one, I was listening to on the commercial break there, Dr. Fauci's interview. Regardless of where we're at with the case count, it's pretty evident now that we're opening up the economy, and they're getting rid of things like the mask mandates in a lot of states. And so I don't see a reversal on that. I really don't. And so, and also investors have not really understood that there's probably not going to be any tax hikes this year. So they'll understand that once we get closer to April and people are talking to their accountants. But without tax hikes in a midterm election year, whereas I think whether, I don't really care what side somebody's on the political side, but there's a little momentum for the GOP, I think. And I think from an investor standpoint, not any more new regulations and things like that will seem bullish.
Yeah.
And I think it'll promote risk taking.
All right, we're going to run. Hey, listen, thanks for stopping by. Jimmy Lee, founder and chief executive officer of the Wealth Consulting Group out there in Vegas, $2.7 billion in assets under management, and talking about his thoughts in terms of the environment. We're going to find opportunities.
Yeah, his COVID thoughts are really interesting, Carol. Reminds me of what Michael Dowling, CEO at Northwell Health, told us earlier in the show. We are on the exit ramp of COVID. We're in a good place right now.
Yeah, I mean, it is interesting. And we are also increasingly learning how to deal with this and move forward on it. All right, folks, just a few minutes left in the trading day. Equities just off their highs of the session, barely higher on the S&P. Dow and the NASDAQ still down, but we definitely did see reaction when it comes to the equity markets coming off its lows following those FOMC minutes. All right, we're going to head over to our TV team for Beyond the Bell, our cross-platform coverage on radio, TV, and YouTube. We are counting you down to the close on this Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to that closing bell, here to help take us beyond the bell. It's our global simulcast partners, Carol Masser and Tim Stenovic. We welcome in our audiences across Bloomberg Television, radio, and YouTube. A lot of sharp moves right now, Carol, in this market, in equities and bonds. And I just want to point out real quickly, a huge spike down right now in WTI crude, now back down below 91 bucks a barrel, was as high as 95 earlier in the day.
Yeah, interesting reaction, especially coming off those FOMC minutes. I love our Markets Live blog saying no fresh fodder when it comes to the hawks when they are thinking about the Federal Reserve. It feels like everybody just calmed down a little bit, and you saw that play out, certainly in the equity markets, and yields just coming in a hair.
Yeah, it was interesting to see the narrative shift around the day before we got those FOMC meeting minutes over concerns about geopolitical tensions to then a essentially a sigh of relief that there wasn't anything more hawkish in those minutes, Caroline.
Anastasia Amoroso were just with us, though, from My Capital, saying, look, it was more hawkish if you look at it. If you think that they're going to listen to some of the words coming out, the in-between meeting discussion points that we hear from members of the FOMC. And she says, look, Bullard, front and center, sort of saying we're going to get hawkish. And interesting, therefore, price moves on the back of that. But really, the market does seem more dovish on the day. We're up on the Russell.
Interesting, all the notes that are coming in, Caroline, from some of those Fed meeting minutes. I just read one that crosses the wire from BlackRock's Bob Miller, saying that the Fed can no longer afford to be data dependent and remain nimble because they are so far behind the curve that they have to get moving and that they have no choice but to get moving absent an exogenous shock to the system. If those aren't some hawkish words, Romaine, I don't know what is.
All right, a mixed bag here for the markets. We were deeper into the red on the day. We broke pretty high into the green here. Looks like we're at the end of the day relatively flat here. About 300 stocks in the S&P are higher, but unfortunately, it's not really the big names that you need to sort of move us. The S&P 500 going to close higher by about 4 points, about 0.1%. The Dow Jones Industrial Average going to close down 52 points, or about 0.1%. The NASDAQ Composite also going to close down by about 0.1%. The Russell 2000, a little bit more pep in its step here, up only about 3 points or so, just about 0.1% or so on the day, Carol.
I like that pep in your step. What's interesting, too, in terms of the decliners and the winners, especially the winners, I felt like it changed to some extent in the S&P 500 after those FOMC minutes. As for names in the S&P, 305 names higher and Taylor 199 lower.
And you really see that, Carol, when you take a look at some of the individual sectors, certainly a little bit more green than there is red. I think what really stands out to me is energy. Once again, the best performer on the day. Yesterday, I think crude fell more than 2 standard deviations below sort of its average, and energy stocks were the underperformance. So you're really seeing that reversal today. You go down the board, there are a few losers. It's food and staples, and it's software and services and technology, but those losses really are no comparison to some of the previous losses that we've seen earlier, Carol.
All right, just quickly through some of the gainers because we are awaiting some big earnings after the close. Kraft Heinz up about 5.6%, so just off its highs. That was top in some of the major equity averages. Fourth quarter earnings topping estimates, price hikes helping the company offset those higher costs. Airbnb, we broke that down after the close yesterday, up about 3.7%, too, also beating on the top and bottom lines. The company's CEO saying the best in their history. And then Huku. Oh, we got some earnings.
Yeah, let's. I'm going to interrupt you there. You can get to Huku later. We should point out Applied Materials reporting earnings right now. The 1Q numbers here. The adjusted EPS coming in at $1.89. That's slightly above what the street was looking for at $1.85. Net sales at $6.27 billion, slightly higher than the consensus estimate of $6.17 billion. We should point out we're going to get a lot of semiconductor earnings here after the bell, including from NVIDIA as well. We got Advanced Analog Devices, earlier in the day, and they had a pretty good quarter. So something to keep an eye on here as we get deeper beyond the bell here with some of these Philadelphia semiconductor names and whether maybe they give a boost to the market tomorrow.
I want to take a look at Tripadvisor as well because we're getting earnings from them as well. Looks here like fourth quarter revenue comes in a little bit light, $241 million versus expectations of $249.5 million. Looking, of course, at their bottom line, fourth quarter adjusted loss per share is 1 cent, and that was versus expectations of a gain of about 8.7%. So you're seeing a little bit lower on both the top and the bottom line, and an adjusted EBITDA that comes in a lot lower than expected, well, at about 29 million, Caroline, versus estimates as well of 45.7 million.
And this is important because, again, it's another tell on our desire to get back out and the fact that we're falling 8% after hours on Tripadvisor on the miss of this. Maybe some optimism built in through Airbnb and the likes of the other Expedia, the outperformance that we saw in those earnings, but Tripadvisor not managing to live up to expectations.
Yeah, I wonder if this is something very specific to Tripadvisor because it seems like some of the other earnings that we've had and some of the other data we've seen shows that we're getting back out there. We are buying tickets, we're booking hotel rooms and Airbnbs, and I guess just trying to get back out there.
Competition with Google, right?
Yeah.
Well, but it is interesting, right, that you don't always get the same story from all of these companies as the economy reopens. And so this is why it's interesting. I'm waiting on Doordash to see whether or not how that was impacted by the variant and whether or not
Have you booked any big trips yet, Carol, for this year, 2020? Not yet?
Have you booked any big trips?
I have, but I'm not going to tell you just yet.
You're such a mysterious man, such a mysterious man. AMAT, by the way, guys, up about 3.7% here. We're waiting for what on NVIDIA as well, and Cisco, another big one.
Yeah, I want to go back back to AMAT because the company's president and CEO, Gary Dickerson, alluding to supply chain challenges for the company in the company's press release, saying, while the supply environment remains challenging, Applied Materials is doing everything we can do to deliver for our customers, and we recorded our highest ever quarterly revenues. Our outlook for 2022 and beyond is very positive as long-term secular trends drive our market structurally higher, and Applied's broad technology portfolio puts us in a great position to capture a larger portion of our served markets.
And I just want to point out, one reason why we pay so much attention, obviously they make basically the machines that make the semiconductors.
Yeah. Yep.
And so when you talk about who their customers are, you get a good read here on maybe what they're feeling or maybe what they're not feeling.
And that is why Cisco is going to be such an important read as well, because here's a company that wants to get the hardware into your offices, wants to be able to offer you the services that come with. But if you've got a supply shortage, what does that mean for their overall ability to service the demand they've been seeing? So that's going to be an interesting tell. But as we see, some of these chip makers have been on fire. We're still waiting NVIDIA as well.
We are indeed, of course, as we wait to watch those. I think what stands out to me, we're looking at Tripadvisor again. Listen to this, you guys. For monthly unique users, they're still only about 73% of 2019's same period.
Wow.
Previously was 55, 70, and 76. So you haven't really seen sort of a broad recovery back to 2019 if you're still only seeing 23%.
Yeah.
And their operating expenses are still up 30% year over year.
Let's go to Cisco quickly, and because we are getting their numbers coming out, second quarter revenue, $12.7 billion, basically in line with the $12.66 billion that had been anticipated for their fiscal second quarter. They're seeing third quarter revenue to grow anywhere from 3 to 5%, so slightly ahead of the overall expectations. We're seeing the shares rise more than 3% after hours as they see a third quarter adjusted earnings per share, 85 to 87 cents, but that's just below where the overall expectation was for 87 cents, but still growth in the next quarter, it would seem, from revenue.
All right, Cisco, an important one, especially they continue to shift, right, to software and other services. Doordash, not so great, down about 9% here in the after hours. Fourth quarter revenue, pretty much in line, 1.3 billion. The estimate was 1.29 billion. Company talking about the outlook. So sees first quarter adjusted EBITDA 0 to 50 million. Huge miss. The estimate was for over $100 million. 2022 marketplace government, they're talking about 48 to 50 billion. The estimate was 49, but that number, first quarter adjusted EBITDA, Tim, that is a big miss.
Yeah, it certainly is. Let's go through these once again. This sees the 2022 marketplace coming in 48 billion to 50 billion. Estimates were for 49.09 billion. Sees 2022 adjusted EBITDA 0 to $500 million. Quite the range there. Estimates were for $452.3 million.
All right, yeah, and we're seeing the shares really all over the map here. And it's interesting because we were talking, I believe it was with Mandeep Singh from Bloomberg Intelligence when we got Uber earnings and kind of the discussion about Uber Eats and just kind of the delivery space in general and how these companies adapt to it. And he kind of made it clear that profitability for these companies, at least for that delivery side, it's kind of going to be elusive. It's just basically the business model.
And is it elusive with all these subsidies, Carol, until you get someone to buy them out and you get just further consolidation and then the subsidies and the competing on price no longer is a huge factor?
Can I just jump in? Cisco increasing its buyback authorization by $15 billion. So if you want to see a stock move, like you think about, this is what we've heard from a lot of market watchers, that these companies have so much money on their balance sheet. Do they do deals? Do they ultimately do buybacks, which is certainly a theme that we've seen easily over the past decade?
Or do they do M&A, like we saw with the fact with Doordash doing some purchases, and how much is that liked by current regulators? But interesting that once again, companies trying to sort of reward the investor base for sticking with them as we ride out the ongoing narrative of how much future they can tell us about when we're still within COVID. This is a company, Cisco, which of course has a hybrid work revenue they call of $1 billion. But as they say, increasing that buyback authorization, just authorization, but we'll see how much of that they actually make in the market. $15 billion worth.
Yeah, and just to recap here, some of these after-hour moves. I mean, Cisco up more than 4%. It's the third biggest mover here in after-hours trading. The biggest mover, actually, not right now, is Doordash, which is up about 19%. Applied Materials, those earnings also came out. Those shares higher, Carol, by about 3%.
Yeah, something to play with. And as you said, Doordash turning around now, up 17%.
Are we supposed to get a Boston beer today?
Yeah, we are. Speaking of share buybacks, Bloomberg Intelligence saying that the company could buy up to 15% of its market cap.
And I hear beer prices are on the rise.
Yeah.
What about hard seltzer?
You guys were at
that's the problem with Sam,
at the
right?
Super Bowl, right? And it was all
we
just
didn't
like
go
beer
to
seltzer.
the game,
What is
actually.
beer seltzer? Did you have this?
We did did not go to the
isn't
game.
Beard already?
Just clarifying. We want to get it right. Just
wink. Okay, I got it.
NVIDIA is still coming, everybody. It's all about chips today. All right, we got to run. That'll do it for our cross-platform coverage on radio, TV, and YouTube. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, a bunch of earnings. Doordash up 21%. We've got Tripadvisor down about 10%. Cisco, that giant stock authorization. We'll see ultimately, as Caroline said, what they do, but that stock's up more than 4% in the after
Yeah,
hours.
we're still waiting. Boston Beer Company ticker SAM, the parent company of Sam Adams. We're also waiting on NVIDIA to report earnings as well. We'll bring those to you live when we get them. In the meantime, let's get a check of world and national news with Nancy Lyons in Washington, D.C. Hey, Nance.
Thanks, Tim. It's full steam ahead with diplomacy concerning the Ukraine crisis, with President Biden speaking with German Chancellor Olaf Scholz this afternoon, and tomorrow European leaders holding an emergency summit. Still no sign, though, of de-escalation on Russia's part, despite the Kremlin saying it was pulling back some troops. NATO Secretary General Jens Stoltenberg says the door remains open to Russia.
NATO remains prepared for dialogue. It is not too late for Russia to step back from the brink of conflict and choose the path of peace.
Stoltenberg says while peace remains an option, NATO defense ministers have decided to look at strengthening NATO's deterrence and defense, including establishing new NATO battle groups in Central, Eastern, Southeastern Europe. Well, some good news today on the pandemic front from CDC Director Rochelle Walensky.
Omicron cases are declining, and we are all cautiously optimistic about the trajectory we are on.
Despite the progress, though, Dr. Walensky says the CDC is still assessing whether to relax mask guidance. There's also some uncertainty about whether we will need a second booster dose. A Florida judge is blocking the release of further records connected to the death of comedian Bob Saget. This comes the day after Saget's family filed a lawsuit against the Orange County Sheriff and Medical Examiner's Office. The family claimed that the further release of records, including photos, would cause them to suffer irreparable harm in the form of extreme mental pain, anguish, and emotional distress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Nancy Lyons in D.C. Hey, folks, we want to just rehash some of the earnings that just came out. Cisco, one of the big ones, and I feel like the headline that really is catching my attention is the company increasing its buyback authorization by $15 billion. As Caroline Hyde reminded us, that's just an authorization, doesn't mean they ultimately do it, but that caught definitely in investors' attention. Let me just pull up the stock. We have shares of Cisco, up almost 6% now.
Wow. Hey, on the flip side of that, Tripadvisor shares are lower after the company's fourth quarter adjusted loss per share misses estimates. Shares fell 11% initially in post-market trading, Carol. Reminder, the company's also still on the hunt for a new CEO as it looks to fill that leadership position.
Yeah, but that's really tanking in the after hours. And stock was up about 7% in the regular trade heading into it. Hey, just go back to Cisco for a second. We mentioned the big buyback. Company giving some thoughts on the outlook. Sees third quarter revenue growing up 3 to 5%. The estimate out there is 3.7%. I talked to the CEO, Chuck Robbins, back in January for the Bloomberg Year Ahead event. And, you know, he was talking about this year, and he said the comparisons over last year are hard. Last year was off the charts, but he said he's still seeing people, you know, this whole idea of working from home, tapping into the products that Cisco sells. And so as people and companies specifically are really upping their IT purchases, Cisco stands to benefit.
Yeah, it does. This is the company that makes hardware that runs the backbone of the internet, but increasingly looking to move away from hardware more into software and services. That's higher margin businesses there.
All right, let's talk about Doordash. It is up 19-20% in the after hours. This stock, though, is down 36% year to date. So Doordash revenue jumping on record orders as dining habits stick. Customers placing 369 million orders in the fourth quarter. That is a lot. Doordash to invest heavily in new verticals and global expansion. Omicron, you know, you wonder
this is
how did
interesting,
this play
though, Carol.
into it.
The forecast, adjusted EBITDA, in terms of the forecast for the current quarter, the estimate was for $100.8 million. The company sees adjusted EBITDA from $0 to $50 million.
Which to me seems like a big disappointment.
It does.
So I don't know, maybe it's just investing in the future. Anyway, these stocks on the move.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Fed Wednesday and a busy day for earnings after the bell. Let's begin with Cisco Systems. Shares up now by just about 5% in extended trading after the communications equipment company reported second quarter results that beat expectations, also raised its full year view for adjusted earnings. The other piece of news out of Cisco, it is increasing its buyback authorization by $15 billion. Again, Cisco after hours up by roughly 5%. We are awaiting the latest numbers out of NVIDIA. They're based in Santa Clara, California. Doordash, though, surging 26% after hours. Doordash reporting a 34% increase in revenue in the fourth quarter, benefiting from a record number of people who ordered from the food delivery app and showing that pandemic eating habits are sticking despite COVID-19's fading threat. Stocks edged higher today after minutes from the Federal Reserve's last meeting did little to alter bets on the path of interest rates this year. Treasuries rose 10-year at 2.02%. S&P, choppy session there, ended though with a gain of 4 points, up by about 0.1%. The Dow down 54, down 0.2. Nasdaq lower by 15, down 0.1. Gold, spot gold up 0.8%, $18.68 the ounce. West Texas Intermediate crude down 2%, $90.25 a barrel on WTI. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Really appreciate that update. All right, we are watching earnings cross. We're waiting for NVIDIA. AMAC cross, though, already, and the stock is, just quickly, I think it's up about 2.2% here in the after hours following its latest results. Let's get to it. Dan Morgan is Vice President and Senior Portfolio Manager at Synovus Trust Company. Tim, they've got $22.6 billion in assets under management, follows the chip sector, watches tech. He's on the phone in Atlanta.
Hey, Dan, great to have you back with us. We are also following Cisco earnings, which came out just a little while ago. Shares are higher in the after hours by 4.8%. The company forecast revenue for the third quarter of plus 3% to plus 5%. What are your takeaways?
Buyback.
Yeah, buybacks. That's an important one too, Carol, right? Authorizing how many billions of dollars was it, Carol?
I think up to $15 billion. That's huge, Dan.
Yeah, it looks like a really good number. And, it's kind of funny, Tim and Carol, is I think I've been following Cisco for over 30 years. I remember when they were known as a router switch company, and they compete in that space.
Nothing
and they were
sexy
one of the first
there, right?
companies, to do the movement away from the mainframe and Unix over to the client server environment. They were one of those four horsemen back in the 1990s, a real great stock. And then it kind of fell on hard times, right? That market became very mature, and now they're making this migration over into some of these newer business lines. And it looks like, based on this number, Tim and Carol, it looks like they're having some success. You look at some of their divisions, for example, on the quarter, security, agile networks, that beat came in at $5.9 billion. Internet for the future, also beat at $1.32 billion. So I think, like you said, Carol, I think the street's really focused on that buyback increase to $15 billion. And it looks like a solid number in terms of guidance going in the third quarter. Go ahead. I'm sorry, Tim.
No, that's okay. I'm glad you brought up the transition that Cisco made in the 90s, from the 90s to what it is right now, because it's going through another transition as it continues to move away from hardware and get companies that are its clients to buy more software and services. And I'm wondering if you think that the company has what it takes to make that transition in 2022.
Well, you're right, Tim, and it's a tough transition, right? I mean, their projected growth rate, even based on this quarter that came out, is like 5 to 7%, right? Compare that to Microsoft, right? We talked about them earlier. They were growing in excess of 20% on the top line, and they're a company that's been around a long time, like Cisco, that has successfully made the migration over to cloud in terms of software as a service. And here we have Cisco, an old hardware company, also trying to make a transition into a more subscription-based software model, which has become more challenging for them. So, to be honest with you guys, Cisco to me is a company that pays a very high dividend, like Hewlett-Packard and Hewlett-Packard Enterprise, but it probably isn't the same growth company that it was 25 years ago. Does that make sense?
Yeah. Yeah, absolutely. I'm just looking at gross yield of 2.8% on that dividend. Hey, NVIDIA is out. I just want to point it out. It's jumping around here in the after hours. It was rallying. Right now, it looks relatively flat here. Fourth quarter adjusted EPS, it's a beat, 10 cents better than what the street was expecting. Fourth quarter revenue, top line, $7.64 billion. That is above the estimate of $7.42. Fourth quarter adjusted gross margin, 67%. The estimate was 67.1. As for the outlook, seeing first quarter revenue of $8.10 billion plus or minus 2%. And the estimate out there is $7.22 billion. Yeah, but it's given it. Yeah, right. I mean,
even
it
minus,
seems like right.
Minus 2% there would still be above $7.22 billion.
Yeah. So Dan, what do you make of that? I mean, the stock's kind of bouncing around here, a little changed, a little higher.
Yeah, Carol. I mean, it looks like a beat that you mentioned revenue. Do you have the gaming and data center revenue number? I was looking for gaming up 35% at $3.36 billion. I had data center at $3.145 billion. Up 65%. Those are their two growth areas. But it looks like initially, Carol, the numbers you read me were pretty positive.
Yeah, I'm looking here. Data center. Here you go. Nope. Data. Forgive me. No, I just had to go through it. Looks like data center revenue was $3.26 billion, up 17% year over year. Gaming revenue $3.42 billion. That was up 37% year over year. Does that help you out?
Yeah, both of those beating estimates.
Yeah, so those look like good numbers, and we would expect that too, because we know that AMD reported a couple weeks ago they make chips that also go into the servers that go into the infrastructure as a service data centers that we always talk about with Amazon with AWS and Azure with Microsoft and so forth. And we know that GCP also had a good number with Alphabet in terms of their revenues they're generating in that space. So we would look for those numbers to roll into a good solid data center number for NVIDIA. You know what the issue, I think, Carol and Tim's kind of stepping away from the stock. It trades at a very high valuation, right? It's kind of in that 50, 60 times earnings handle. So there's just not a lot of room for not a lot of room for margin. Yeah, it's got to execute on everything. It's got to beat on everything, and it's got to have great growth just to satisfy the street. Yeah.
Hey,
so it's like it could do good, and it's not good enough.
Yeah, exactly. Right. It's like dealing with parents and kids. Right there it is. Hey, just got about 20 seconds. Intel, its deal. Intel CEO Pat Gelsinger, he's tired of Wall Street doubting his turnaround plan. Are you buying it? Just quickly.
Yeah, I'm kind of buying in on Intel, even though in the past they've disappointed me. They tried to get into communication chips back in the 2000s, and it didn't work. But yeah, I saw the deal they did with Tower, and I'm very optimistic that they can actually become a foundry and compete against the likes of TSMC and Samsung and the rest of them. And you know what? We need them to, right? We need a U.S.-based foundry.
That most people would argue that's for sure. Hey, Dan Morgan, be well. Dan Morgan over at Synovus Trust on the phone from Atlanta. Lots going on this Wednesday.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Hey, did you notice Cynic was worthy?
I didn't get it. Did you? No, it wasn't today. It was yesterday.
Oh, it was yesterday. It was really hard. That why? I was like, what?
Yeah, I did not. I was my first one in 14 that I haven't gotten. It's gotten harder since the New York Times spotted, I think.
Darn it. All right, coming up, we're going to talk about real estate, specifically when it comes to the retail space. So we'll get to that in just a moment with Anjali Solanki. She is over at Colliers.
Can we talk metaverse too? Maybe just a little bit.
Maybe metaverse.
Okay.
All right, first of all, certainly with his feet on the ground, Charlie Pellet.
All right, and indeed, the word after hours earnings, a number of high-profile companies, NVIDIA with revenue for the fourth quarter that did beat the average analyst estimate, shares slipping, however, after that report, down now by about 1%. Doordash delivering for investors after the bell, up 29%. Doordash reporting a 34% increase in revenue in the fourth quarter, benefiting from a record number of people who ordered from the food delivery app. Cisco Systems shares up by roughly 5% after the communications equipment company reported second quarter results that beat expectations. It also raised its full-year view for adjusted earnings. Dan Morgan is senior portfolio manager at Synovus Trust. He's been sorting through the numbers. He spoke with us moments ago right here on Bloomberg Business Week.
You look at some of their divisions, for example, on the quarter, security, agile networks, that beat came in at $5.9 billion. Internet for the future, also beat at $1.32 billion.
It is a Fed Wednesday. Stocks closed higher after minutes from the Federal Reserve's last meeting did little to alter bets on the path of interest rates this year. Jimmy Lee is CEO at Wealth Consulting Group. He does not see a 50 basis point increase, but says if the Fed does move a half point, he thinks the market's going to take it all in stride.
I think the market, the economy can absolutely stand 50. So if that were to happen and we get some short-term volatility from either that or an invasion into Ukraine, I still think I'm constructive on equities for this year and the economy. And I would use that as a buying opportunity if you're a stock investor.
And Lee was a guest right here on Bloomberg Business Week. S&P up today by 4 points, higher by less than 0.1%. Really choppy session today. Stocks all over the place, especially with the FOMC minutes. The Dow ended the day down 54 points, down by about 0.2%. Nasdaq down 15, drop of 0.1%. 10-year yield 2.03%. Spot gold up 0.8%, $18.68 the ounce, and a retreat today for crude oil, down 1.7%, $90.50 a barrel on WTI. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we did get that read on retail sales rising the most in 10 months, broad-based rebound. You really have to dig, though, into the details to understand, because auto was a big part and furniture among the biggest gains.
Let's talk a little bit about U.S. retail from a real estate perspective. Joining us now is Angie Solanki, National Director of U.S. Retail at Colliers, the commercial real estate brokerage services firm. How are you, Angie? Good to have you on the show.
Thank you so much. It's great to be on the show with you.
So just give us an update right now on how things are going around the country. We like to check in with Colliers pretty much once a quarter to get the temperature of what's going on when it comes to commercial real estate and where things are. How would you characterize foot traffic and the temperature compared with pre-pandemic?
Yeah, it's a great question, Tim. So the retail sector definitely has seen a nice kickoff in 2022. And nevertheless, we're still spending, mostly due to the transfer of spend from services to products, since entertainment and leisure are still not back to normal fully. The great news that we're seeing when it comes to retail is really around the absorption. So roughly 76.5 million square feet of space has been absorbed since the end of 2021, which is the highest figure recorded since 2020.
What does that mean?
So basically what we're seeing is store openings are actually outpacing store closures. And it's great to see that because it's become quite dynamic. Retail has definitely morphed into traditional retail to non-traditional retailers expanding. So a lot of wellness, healthcare, medtail, retail that we call it, expanding into a lot of the retail developments. So you're starting to see this integration, which has been fantastic. Also,
is it sticky? Is it sticky? Is it sticky that stays?
Oh,
yeah.
Yeah, most definitely. Look, we have all looked at, convenience as being a primary factor, right? Especially right now where we have been working remotely, working from home, trying to kind of, work from home, but also, have family and kids still sometimes staying at home and going back to school. So this convergence is really starting to create a pure factor of convenience. If I can go to a shopping center and take my pet and have my pet, go to the veterinary, the new modern vets concepts we're seeing, or going to a medical, clinic at a shopping center and then go grocery shopping right after. Hey, it's all about convenience and about time.
All right, so where's the dead space? Where's the space that's not coming back?
So a lot of the space, so one thing that was really fascinating, we were looking at some of the stats with ICSC, and, overall occupancy has hovered around 90%. So the dead space that we're starting to see is going to be in maybe some of those markets where you had product that was already, C and D, B minus retail that really never came back regardless of the pandemic. Those are the spaces that are still lingering out there. But we're also seeing new concepts taking some of those spaces, i.e. as warehouse space, because there's, there's a need and demand still for that last mile.
Angie, I've heard you talk a lot about healthcare services, biotech, and the idea of offering services that, can't really be replicated online at this point. How much of an area of growth is that for retail space right now?
Oh, gosh. In terms of numbers, this is just a pure guesstimate. We haven't really tallied it, but I would say that when you look at an average shopping center that's roughly, let's say, 200,000 to 300,000 square feet, we're looking at, medtail retail or medical retail coming in and probably taking 5 to 10% of that space. Mm-hmm. So it's a pretty significant amount. So the larger the square footage of a shopping center, the higher that number may be. But that's, we're looking at, wellness, healthcare, mental wellness. There's a lot of different concepts that are coming out.
Yeah. Hey, listen, Angie, sit tight for a second. We've got to do a little bit of news, but we'll come back. Get back to Angie Solanki. She's National Director of U.S. Retail at Colliers. They're publicly held real estate services and investment management firm. They've got about $51 billion in assets under management global. So they see real estate, all the different verticals, and of course we're talking retail here.
Yeah, and that's really what I want to hit on when we come back. Talk a little bit about the differences between the U.S. and other parts of the world as we see the pandemic ceasing in some areas.
Good point.
All right, subsiding, maybe I should say.
Yeah, well, I know, right? Fingers crossed. All right, let's get to world and national news. Back on over to Nancy Lyons. Hey, Nance.
Thanks, Carol. Tensions are still high at the border between Russia and Ukraine, with Russia claiming that it's pulled back some of its more than 130,000 troops, but with some analysts claiming Russia has actually added troops. White House Press Secretary Jen Psaki addressed the inconsistencies with reporters.
There's what Russia says, and there's what Russia does, and we're watching very closely what steps they're taking, but they remain amassed in a threatening way at the border.
Psaki says they're watching out for false flags from Russia, things like fake videos, false accusations about chemical weapons, or lies about attacks on Russian soldiers. The FAA has reportedly referred dozens of new cases of bad behavior in the air to the Justice Department.
43 new cases of violent, unruly behavior in the air are being sent over to the Justice Department for potential criminal prosecution. That's according to CNN. This week, Bloomberg News reported the nation's largest airlines have been in talks for months with the Biden administration on a national no-fly list of problem passengers. The FAA has opened investigations on more than 1,000 reports of airline violence in the past year, most of them related to mask mandates. In Washington, I'm Nathan Hager, Bloomberg Radio.
Government investigators say former U.S. Interior Secretary Ryan Zinke, who served in the Trump administration, misused his position to advance a Montana development project, and they say he also lied to an agency ethics official about his involvement. He's now running for Congress in Montana, and his campaign calls the report a political hit job. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, you are listening to Bloomberg Business Week. Try that again, right here on Bloomberg Radio. Carol Massar along with Tim Stanovic. So this is among our most read, or if not the most read story on the Bloomberg in the past 60 minutes.
Yeah, it has to do with New York City's Mayor Eric Adams. He's got a message for CEOs in the city. Time to end those work-from-home policies. Here's what he said. We can't send mixed messages. Quote, we can't keep kicking the can down the road. He's talking about different major banks, tech companies, and more that are essentially continuing, Carol, to delay those return dates.
It's very interesting. This is one of the great debates that is out there, because some CEOs will say, oh, well, yeah, we're back to work. And that back to work means sometimes you're in the office, sometimes you're not.
Right, there's the David Solomon side, right, which is at Goldman Sachs. We're an in-office culture.
Right.
And then there's the other side, which maybe you could call the, I don't know, Twitter approach, where there are many other companies.
Right.
Where they're saying you can be completely remote.
Forever.
Yeah.
Right? At least that's what they're coming at. He did, the mayor of New York City, Eric Adams, said he met with 100 chief executive officers this week as part of scheduled meetings his office has with both small businesses and corporations in the city. He used the meeting to coax them into participating in his summer youth jobs expansion and to get their workers back into the office to stimulate the city's economy. That's what it's about.
That's exactly what it's about. Because if you're working from home, you're not coming into New York City. That's money that the city's not getting in terms of tax revenue.
Not buying lunch. You're not dropping stuff at the dry cleaner. You're not getting shoes repaired. You're not shopping at Sephora for that blush you don't really need.
Yeah, that's true.
Sorry,
I did see.
that was
I
random.
actually walked by a Sephora on the way home.
They're actually always
and
busy.
They are busy, and I noticed the other day. It's funny that you mentioned this, Carol. They were doing the in-person. You know, Sephora is known for the experiential.
Yeah.
I mean, there's like business school case studies on this, right?
Right.
They're known for the experiential. Go on in there, and you get done up, and you get to try these products.
Get free samples.
They were doing that.
Yep.
You know, and this person was not wearing a mask.
Yeah, they've gotten back. It's taken them a while, though, where you can actually get like makeovers and services. It's taken them a while to get back. And for a long time, you couldn't touch anything. You could go in, but you couldn't actually play with the product, and they're back to it. Anyway, the mayor of New York City says, come on, time. It's time for everybody to get back. CEOs, get your workers back to work.
We're here.
We are here and have been.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Busy session for earnings after hours. NVIDIA out with revenue for the fourth quarter that beat the average analyst estimate. Shares those slipping after that report, down now by about 1%. Doordash now up 25%. Worth repeating, Doordash up 25%. It did report a 34% increase in revenue in the fourth quarter, benefiting from a record number of people who ordered from the food delivery app, showing that pandemic eating habits are sticking despite the fading threat from COVID-19. Cisco Systems up by 5.5% after the communications equipment company reported second quarter results that beat expectations. It also raised its full-year view for adjusted earnings. Stocks closed higher after minutes from the Fed's last meeting did little to alter bets on the path of interest rates this year. S&P held onto a 4-point gain. Very choppy session today. The S&P up by about 0.1%. The Dow down 54, drop of 0.2%. NASDAQ lower by 15, drop there of 0.1%. Spot gold up 0.8%, $18.68 the ounce. The 10-year yield on this Fed Wednesday, 2.03%. West Texas Intermediate crude retreating 1.5%, $90.72 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get back to our guest, Angie Solanki. She's National Director of U.S. Retail at Colliers. You know them well, publicly held real estate services and investment management firm, and she's still with us on the phone in San Francisco.
Angie, I know that you oversee you're the National Director for U.S. Retail, but Colliers is a global operation, so I want to get an understanding of what's happening around the world right now. How would you characterize the different pace that other parts of the world are leaving this pandemic, hopefully? I mean, what is the data telling you?
Yeah, what's really interesting is if we stop and look at the different countries in terms of omni-channel. And so when we looked at the omni-channel percentage change year over year, you're looking at anywhere from 3 to 5% increase in terms of countries adopting the omni-channel, which in effect really is helping the overall consumer economy, the revenues for retailers, et cetera. And what I mean by that is, for example, we're seeing fast food chains who are reporting revenue growth from digital orders making up 1/3 of some of the company's global sales.
Mm-hmm. But is that pandemic, or you think that's stuff that sticks?
I think that's going to stick because, again, it goes back to convenience. And so whether you're going back into the office and you're accustomed to ordering online for certain food goods or fast food lunches, etc., I think that's going to continue.
So one thing I want to ask you, Tim and I, if we walk out the door of Bloomberg headquarters, there is available space, I think at least 2 spots across the way. On the corner, there used to be the Container Store.
There was a Starbucks in our building.
And a Starbucks.
That's gone.
They're both gone. And the Container Store had a pretty big space. I mean, there's a lot of open spots as you walk around.
That's just our block.
And that's just our block.
Right.
So help me out regionally. You know, Tim was just asking you a global question, but I do wonder, it does feel like there's some really rough spots when it comes to retail and real estate. And then, of course, there's the American Mall across the way that continues to kind of figure out its way. I mean, that's kind of a special case, but it's been a special case with a lot of, years of tough times.
Sure. No, I would definitely agree that in certain markets where we have, dense urban, areas, those areas definitely we're going to see a slower growth back to, higher occupancies, et cetera. But the positive news on that is that although we are seeing these vacancies in various sizes, we're starting to see the retailers coming back to tour these markets. So what we're seeing is that they're coming in, they're touring the markets because they're ready to start staging and identifying space to reopen. It may most likely be a different concept. It might be a larger or smaller concept. It might be, that Container Store might convert into multiple stores. But we are seeing tour activity from retailers start to peak up again. And this is from global brands.
So I'm wondering about the permanent shift that we see on the other side of this pandemic. What fundamentally changes when it comes to commercial real estate, when it comes to occupancy, when it comes to who and what is occupying these spaces?
So I would say from a forecast perspective, there are still those outside influences, right? And that means, when we start to see, the inflation, margins for retailers starting to creep back up if they're not normalizing, hopefully by the summer of this year. But we're also starting to see, retailers take some of the capital that they've harvested, and as you probably may have seen, some of the call it top, tiered retailers are definitely starting to take their capital that they've harvested and put it back into either remodeling stores, making stores more efficient operationally, where they're, looking at point of sale where it's directly done by the consumer themselves. So there's new technology, new systems that are starting to come back in and be deployed. And through that effort, we will start to see the opportunity for retailers to basically take on more retail, but maybe at a smaller footprint, or they're going to be more operationally more optimized. So they're able to start reinvesting capital in more that omni-channel approach.
So Angie, I'm just thinking about our audience in terms of investors thinking about the real estate space. I do think, we've all expected some real fallout, significant fallout because of the pandemic, but it does seem like there's been a reallocation and somehow, for the most part, getting through. What do you think our investment audience needs to understand about what you are seeing when it comes to U.S. retail space in particular?
Yeah, I would say that from a capital markets outlook, from an investors are actually coming back into the retail space, and we're actually seeing that, based on fourth quarter 2021 sales, and this is actual sales of shopping center, that the fourth quarter actually accounted for roughly 36% of total sales for the year. And that, for the year sales total amount was $84 billion. So we're actually forecasting pretty strong NOI growth in the next 5 years from a retail pricing perspective, reaching somewhere in the range of 5% in 2022. It's probably going to be the largest increase in value since 2015. Of course, that's oriented around grocery-anchored shopping centers, but we're going to continue to see that optimism come back, and that will start to come back in terms of the urban core retail market. In addition to that, we're also seeing a lift in leasing activity in retail overall.
Angie, what are the shifts that you're seeing when it comes to where people are working? We were just talking during the break about Eric Adams, the mayor of New York, telling people that it's time to come back to work. In 30 seconds, what are the patterns that you're seeing in the U.S. in different cities?
I would say that in some of our kind of more lax cities where mask mandates have come down or much more relaxed, I would say those cities have actually seen a very accelerated momentum when it comes to retail leasing, and retailers are moving into those markets, i.e. southeast and central region, in areas where it's a little bit more, mask mandated. We definitely are seeing a very slow reaction and come back in those cities.
All right, we got to run. Angie, thank you so much. Angie Solanke over at Colliers joining us on the phone. Just want to mention, we've got Doordash up 33% in the after hours. Mind you, it was a lot lower heading into it in the regular trade. Cisco's up about 4.7%, almost 5% in the after hours. Got nothing over there, Tim?
No, I don't. I'm just thinking about all these earnings that we have, watching after hours movements.
It was a full day, guys. Have a safe evening. This is Bloomberg.